Hi, in this video I'm going to talk about long buying, short selling and the major differences. So if you're interested, make sure to stick around as we're starting right now. For understanding long buying and short selling, firstly we need to grasp what the terms bullish and bearish means. Bulls are considered to be a symbol of strength, and the way it advances forward represent the players in the market who are optimistic about the stock prices moving up. When an investor is bullish on a stock, it means that they believe that the price of a stock is going to move higher. Being bearish is the exact opposite of being bullish. When an investor is bearish on a stock, it means that they believe that the price of stocks will decline in value. Bearish investors are pessimistic about the stock market. With that out of the way, let's learn what long buying and short selling is. Long buying. Long, going long, buying long, everything means the same, and it does not have anything to do with how long you own a stock. It simply means which direction you are playing the stock. As discussed earlier, bullish investors are optimistic about a stock and they believe that the price will go up. So, what will you do if you think the price of a stock will go up? Obviously, you will buy it. And buying it means you're bullish and you're going long on the stock. Short selling. A bearish investor, anticipating the prices to go down, engages in short selling. Investors borrows a stock to sell immediately when the price is high, and then later buys it back to cover at a lower price and repays the borrowed shares. The investor then gets to keep the difference in price, which is his profits. Confused? Let me give you an example. Let's suppose that an investor is bearish on the company Beyond Meat. Assuming the stock trades at $100 per share and the investor believes that the stock price will further go down to $90. On this assumption, he short sells 100 shares of Beyond Meat. He borrowed and sold 100 shares, making $10,000. Now, as expected, the stock moves to $90 and he covers the 100 shares. By covering, he buys back 100 shares so he can return the 100 shares borrowed back to the broker. To buy back 100 shares at $90, he had to spend only $9,000, which means he is left with $1,000 in profits. Making more sense? Now, the next obvious question would be, how could someone short sell a stock that he or she doesn't own? This is where the brokers come into play, and choosing a broker with huge inventory of stocks matter. When you want to short a stock, your broker can lend you shares from their inventory or from other brokers' inventory, and this is what we call a borrow. Shares that can be borrowed are classified into hard to borrow and easy to borrow stocks. Easy to borrow stocks are stocks that are easily available with your broker for shorting. On the other hand, hard to borrow stocks requires your broker to locate it from an external broker's inventory, and almost all brokers charge you a locate fee for that service. By now, you might be thinking, why would anybody lend shares if they know that it will go down? Why can't they sell it and avoid a loss? I guess it's all got to do with institutional investors, long-term investors and company insiders. These players own a bulk of the total shares and they are invested in the company for the long term. These players are not affected by the short-term market action, and hence the brokers of these players will have a pretty decent inventory. Wall Street always looks for opportunities to make money, and they founded short selling so that they could make money off their unused inventory of stocks. Also, it gives opportunities for investors even in a bearish market. Now, I would like to give my 2 cents on short selling. Personally, I am bullish on the US economy in the long run, and I don't normally short stocks. I personally feel that it's too risky and does not fit with my style of investing. I invest for the long term. Short selling is mostly used by day traders and swing traders, and since I don't fit into that category, I hardly short. When you're long on a company, what is the maximum loss that you can incur? 100% of your capital, right? Now on the short side, what is the maximum loss you can incur? Think for a minute. Infinity. Even though technically it's not possible to have an infinite loss, but you cannot forecast how bad it can be. I wanted to give an example of short selling gone wrong. This is from an article I read on marketwatch.com. As per the article, a trader shorted a stock which was at $2 and held the position overnight. Post-market, the company came up with some positive news and the stock exploded and the price ran up to 800%, making the trader liable to his broker by around $106,000. Remember that when you're short selling, you need to buy back the shares that you borrowed to repay your broker. This nature of short selling exposes the investor to a massive risk if the investor does not have proper risk management. These days, even though brokers have systems in place to limit your losses, I would rather stay away from short selling. That being said, investors and traders should understand what long buying and short selling is, since they're used frequently in financial news and trading articles. Choose your investments wisely and limit your losses. I would like to end this video with one of my favorite quotes of Warren Buffett. He once said that there are only 2 rules in investing. Rule number 1 is to never lose money, and rule number 2 is to never forget rule number 1. So until we see next time, thanks for watching. Bye.